Good morning. Live now. Good morning and welcome to our today's program. My name is Doug Rieder. For those who don't know me, I'm the executive chairman and co-founder of the newly formed Sterling Seacrest Pritchard. You may have heard we announced April 1st that we merged with Pritchard and Jordan, an old line Atlanta firm with a great reputation, and that dates back to the early 1960s. Together, we are one of the largest privately held independent insurance brokerage firms in the southeastern U.S. We're very excited about this, and we are able to provide our clients access to a much broader array of products and services, a depth of experience and knowledge and resources unmatched in the industry. A little background on the firm. We are a multidisciplined commercial insurance agency with deep industry verticals across a number of industries, including healthcare, construction, real estate and hospitality, transportation and logistics, nonprofits, and private client risk. In other words, personal insurance. One of the interesting things about our recent merger with the Pritchard and Jordan is that they bring a number of complementary skill sets to the table. They have got very active practice groups focused on municipal, energy and utilities, financial services, government, schools and social services, as well as law firms and technology firms. And a number of those are industries in which the legacy Sterling Seacrest firm did not do a heck of a lot of business. So we're very excited about the opportunity to work across offices. It's been very successful for us in the past when we merged with Seacrest Partners out of Savannah. So we're very excited about it. We're working out of 8 offices, including 3 in Atlanta, 1 in Savannah, Tampa, Little Rock, Birmingham, and we have a small team down in Columbus, Georgia. So we're licensed across the country and very excited to be working with our new partners going forward. I'd like to thank everyone for joining the program today. This is, I think, our 7th year of putting on these programs since we moved to this office. It's been very successful for us and a great way for us to communicate with our clients and friends and talk about things that are topical in the industry. That's sort of how we got to the idea of putting on a program on this topic today. This has been something we've been discussing with clients in renewal meetings and strategy sessions prior to renewals for the last year at least. But we thought it would make some sense to put some data behind the discussion. And I think you're going to see some very eye-opening information today as we go through the program. My partner, Joey Maxwell, and I are going to talk about several factors that are contributing to a significant rise in insurance claim costs and consequently insurance rates, particularly in the liability lines. Joey has held various leadership positions and remains active in the Associated Builders and Contractors, the Georgia Highway Contractors Association, the Associated General Contractors, and the Construction Financial Management Association, where he currently serves on the board. As an industry expert in construction, Joey's authored numerous articles on insurance and risk management and is an active guest lecturer in this program and in numerous other venues. A little background on myself, since we have a number of new folks, I think, joining us today. I have over 30 years of experience in providing risk management, surety, and commercial professional insurance solutions for construction and real estate clients. I help lead the construction services practices here, which provides risk management, surety, and insurance solutions to over 500 commercial contractors around the country. I've enjoyed writing a number of articles on insurance and surety topics and have been an active lecturer on such topics for several construction associations and institutions. I'm a member of Liberty Mutual's National Surety Producer Advisory Board and serve on the board of a 70-year-old general contracting firm, as well as the organizing committee and board of a recently formed community business bank. At this point, the way we're going to run the program is Joey's going to take the lead on presenting most of it, and I'll step in on a few slides and also offer commentary as we go through the various data points. Thanks so much, and welcome, Joey Maxwell.
Awesome. Thank you so much, Doug, for the kind introduction, and it's good to see everybody out in cyberspace. I'm going to do my best to make eye contact with the camera as we go throughout, and I've set up little borders for myself to stay inside the camera as we kind of go through today's presentation. One quick comment in terms of asking questions during the presentation. As you'll note, everybody is muted, and I'm about 20 seconds into the future from what I found out on the Microsoft Teams platform. So I won't be pausing necessarily for questions, but as you have them, please utilize the chat function here and type them into Katie, and Katie will pause me, and I'll come back and answer any questions or thoughts or comments or concerns or threats that you might have during the presentation. So as you noted now, today's title of today's presentation is Social Inflation, Nuclear Claims, and the Explosion in Liability Insurance. I actually asked our HR director right before we were about to start if she was going to join us. She goes, honestly, you lost me at the title. So I think I'm off to a really good start today. But let's go ahead and kind of dive in and preface this with, I'm a lot of fun to talk to at cocktail parties with a lot of these statistics and figures that I'm going to throw out. And I'm not trying to scare you as we go through a lot of this today. We're just trying to kind of begin pulling the curtain back on what's been happening in the slow creep in inflation and liability claims. So let's start off with, see if that goes down. Bing. So let's just start out with some grounding and anchoring in the topic that seems to be grasping everybody in the news today, which is just the term of inflation. So we can think about inflation as the decline in purchasing power of a given currency over time. So prices going up, value of money going down. We're going to be talking about this in context of certain insurance numbers and trends and liability claim numbers, but I thought it'd be important to kind of set the stage of what this is. We're not going to be talking about economics or CNBC style numbers, but it's often grounded as well into we're often grounding the concept of inflation. We're talking about the consumer price index. So just looking at this, you've got about 8 major groups in the consumer price index, and you'll see this denoted in my presentation on a couple of different slides, noted as CPIU, which is Consumer Price Index Urban. And so you've got housing, apparel, transportation, education, communication, recreation, medical care, food and beverages, so on and so forth. And I joked with someone earlier, I was like, I pulled this picture off the internet of the cars lining up for gas from the 1970s. I honestly should have just walked outside last week and updated my presentation at that point. So as I mentioned, we're not going to be diving into the inflation that everyone seems to be worried about in the news today, but instead, social inflation. So what is social inflation in terms of a term? So to give a dictionary style definition, social inflation generally refers to the rising cost of insurance claims that are a result of societal trends and views towards increased litigation, broader contract interpretations, plaintiff-friendly legal decisions, and larger jury awards. In short, people are more litigious, expecting more, and getting paid more. So giving kind of an outline of some of the major factors that we're going to discuss today, and that we'll kind of take slow, deep dives into. Mind you, this is not going to be a fully comprehensive program. I could sit up here and talk for a week about everything that's going on that's having influence over increased claim costs, societal trends, what you might think is wrong with the world today. But the major factors we're going to talk about are changing underlying beliefs about appropriateness of filing lawsuits and expectations of higher compensation when filing lawsuits, rollbacks of previously enacted tort reforms intended to control costs. And mind you, when I'm talking about tort reforms as we go through this today, I'm going to focus specifically on Georgia. And I know that there are several people on the presentation that are in other states today. And so I encourage you to do research into your own state's tort laws, but I can't cover all 50 states in one presentation. Legislative actions, specifically once again in Georgia, to retroactively extend or repeal statute of limitations, increased attorney advertising, and increased attorney involvement in liability claims. The emergence and growth of third-party litigation financing, which is, if you haven't heard about this topic before, it'll be rather eye-opening to you. Increasing numbers of large jury verdicts, and the proliferation of class action lawsuits. So as I begin diving in, once again, this is not the sexy inflation topic that you might be hearing about on the news, but it's what's quietly hurting you and your business and impacting you and your business, and is not getting talked about in the news nearly as much as it probably should. So let's start diving into some facts and figures and statistics. And I promise I try to make this presentation not groan with the weight of statistics as we go through, but it's meant to highlight a lot of the trends that are going on right now. So let's start here and think about back in Georgia, back in about 2003, we had some processes of legislative reforms with both related to tort liability and other liability lawsuits. And around 2010, a bunch of those started getting rolled back. So when I look at some of these slides, I'm going to focus specifically on commercial auto and medical malpractice. From 2013 to 2018, commercial auto claim losses increased at an annualized rate of 10.9%. And also, quick commentary on a lot of these statistics be up to 2017, 2018, 2019. Insurance is a slow-moving industry, so some of my statistics will feel a little bit outdated. Just know that, in a fun way, it's gotten worse since what I'm going to show you on a lot of these graphs. So 10.9% for commercial auto. And during that same period, medical malpractice insurance claims increased at a rate of 3.2%. And always the fun thing about statistics is they can be super misleading, because if I told you over the last 10 years, medical malpractice insurance claim costs have gone down, that would be true. But from 2007 to 2013, they decreased 3.9%. But in the 2013 to 2018 period, they increased 3.2%. So if I said they've decreased 0.5% over the last 10 years, I wouldn't be lying, but it'd be rather misleading as to what trend is actually currently taking place.
And please keep those numbers in mind for a later part in the presentation, because we're going to speak to some of the reasons that the medical malpractice are trailing these other graphs that are related to sort of some of the partial or potential solutions to this issue.
And as you'll see on the far right part of this graph, I told you I'd be kind of tying things back to inflation as we go, because we are talking about social inflation. So as you'll see, a lot of these annualized changes in incurred losses are far outrunning the pace of inflation over that time, that CPIU number that's over on the right-hand corner. Another piece that's been affecting the insurance industry is massive losses. If you'll notice on this graph, largest insured losses in history, and you'll notice that a lot of them are in the 2000s and a lot of them are fairly recent. Obviously, some of the larger losses always end up being natural disasters, hurricanes. The largest insured loss in history is Hurricane Katrina at about 60, 65, 70 billion dollars. Right, then these figures are in billions. But as we're seeing on the far left hand of this graph, COVID-19 is trailing behind that in terms of actual losses that have taken place, but the estimated losses were just reassessed the other day of what the insurance industry will feel from COVID-19 is about 107 billion. And there's a few sneaky ones that are out there that are still taking place as claims begin to develop, business interruption claims around the world begin to develop. And one of the sneaky ones that's out there is actually the Summer Olympics, which everyone kind of continues to forget might actually happen or might still get canceled. If that were to get canceled, that would be estimated another $3 billion loss to the insurance industry. So Doug's going to step in really quickly and do a quick few slides on interest rates.
Yeah, part of the point of the these last several slides is just attribute what's happening in insurance pricing to the factors that are driving it. So we're going to spend a lot of time on the social inflation piece, and we're going to get behind that curtain pretty deeply with some other slides. But certainly one of the more significant impacts on insurance pricing that we're experiencing right now, which is exacerbating some of these other trends, is the fact that due to the pandemic, the Federal Reserve has, remember back to the earlier slide where you're shooting the gun off of money. They basically have been, printing a lot of money and pushing it out into the economy. There's ongoing discussion about continued stimulus in the form of infrastructure spending, which, we need, thank goodness, and that also, there's a tangible benefit that's going to be long lived that would come out of that. So